Welcome to this deep dive. Today, we're really peeling back the layers on the U.S. stock market. It's sitting at historic highs, right? And our mission today is to sort of map out what's pushing it up and also maybe uncover some of those hidden rocks that could pull it back down.
Yeah, it's a delicate balance, isn't it? We're
Mm.
trying to weigh the optimism against, well, some pretty clear apprehension. There are significant economic and, global risks out there. The big question really is, can this soft landing actually happen? Can inflation come down without a recession?
Okay, let's start with the bull case. What's driving this climb? First up, the Fed pivot. Wall Street seems pretty convinced we'll get a 25 basis point rate cut soon. September FOMC meeting.
That's the Wall spread expectation, yes.
Yeah.
A quarter-point cut, it sounds good. Lower rates, cheaper borrowing.
But hang on, is there a risk that maybe this good news is, already baked into the price?
That's a really critical point. A lot of it is anticipated, I think. But what's interesting, historically speaking, is that stocks tend to do pretty well, better than cash or bonds anyway, during and after the Fed starts easing rates. That is, provided we don't tip into recession.
Yeah.
So the lasting impact could still be quite significant.
Okay, next catalyst, AI. The AI-powered earnings engine. This feels like more than just hype now, doesn't it? We're seeing actual revenue growth, like Oracle projecting that huge 77% jump in cloud revenue. NVIDIA, Adobe, too.
Right, it's becoming concrete. And the bigger picture here, potentially, is this idea of a productivity boom driven by AI. It could create growth that doesn't necessarily fuel inflation. And, the insight might be that these gains aren't always obvious yet in the standard numbers. It might be a delayed reaction like the early internet.
A productivity boom. That would be something. And finally, on the plus side, we're seeing signs the rally might be broadening out. It's not just the mega cap tech names anymore. Other sectors are joining in.
Yeah, things like consumer discretionary, financials, healthcare are starting to show more life. And that generally signals a healthier, maybe more sustainable kind of advance.
Okay, so those are some powerful tailwinds. Feels pretty good. But let's flip the coin. Because beneath that calm surface, there are definitely some storm clouds gathering. Let's talk risks. And the biggest one, near term anyway, seems to be trade policy, specifically tariffs.
Oh, absolutely.
We already saw the market react badly back in April when tariffs were announced, panic selling. And now there's talk of maybe a 10% baseline tariff on almost everything, plus much higher rates potentially for places like China and the EU. Now, some argue tariffs are, necessary for national strategy. How do we square that with the market impact?
Well, that's the fundamental tension, isn't it? From an economic perspective, tariffs act like a negative supply shock. They slow growth because they raise costs and disrupt supply chains, but they also push prices up. They're inflationary. So you could end up with stagflation, high inflation, slow growth. That's a really tough spot for the Fed.
Right, this inflation wild card. It could force the Fed to rethink those rate cuts, couldn't it? Maybe even, go back to hiking rates. That would pull the rug out from the current rally.
Precisely. That removes the main catalyst we just talked about.
And then you've got geopolitics, Ukraine, the Middle East, conflicts that could easily spike oil prices.
Yeah, and an oil spike just acts like a tax on, everyone. Consumers, businesses, globally. It's another one of those tripwires.
Okay. Any other big risks?
Well, there's the market itself,
Yeah.
its own internal vulnerabilities. Valuations look stretched in places, and the leadership has been incredibly narrow, relying on just a few huge tech stocks. If they stumble, there's a real catch-down risk, where those few names drag the whole market lower.
Okay, wow. So lots of conflicting forces here. With all this going on, what does it mean for you, the listener? What should people be watching? What are the key signposts?
I think the main thing is that macroeconomic dashboard. Keep a close eye on inflation data, CPI, PPI. See if those tariff costs start showing up in prices. And watch the labor market data, too. You're looking for that Goldilocks zone. Gradual cooling, not too hot, not too cold.
Market mood is important, too, right? The VIX, the fear gauge, is pretty low right now, around 14.7. That suggests a lot of complacency, maybe. Like everyone's just expecting smooth sailing.
It does seem quite calm, yeah. And sometimes those periods of extreme calm are, historically, when things are most fragile. There's this disconnect between the low VIX and what seems like pretty high underlying risks.
Interesting. Anything else on the technical side?
Market breadth is critical. Right now, it actually looks okay. More stocks advancing than declining on the NYSE, for instance. And a decent percentage, like over 60% of Sp500 stocks are above their 50-day moving average, which is a positive short-term signal. But if you see the S&P 500 keep hitting new highs, but fewer and fewer stocks are actually participating in that rise, that kind of divergence, that can be the canary in the coal mine, a warning sign.
So it really feels like the market's at a crucial inflection point, balancing this potential for more gains against some really significant, unpredictable turbulence.
Absolutely. And success here probably isn't about perfectly predicting the next move, because who can do that? It's more about, staying vigilant, being flexible, maybe tactically adjusting, and
Yeah.
focusing on building a resilient portfolio. Quality companies, diversification,
Hmm.
the fundamentals.
Right. So that prevailing low volatility, that quiet market, it might feel reassuring. But maybe the final thought is this. What if that very calm is what makes the market most vulnerable? Vulnerable to the next unexpected spark that triggers a sudden jump in volatility, catching everyone completely off guard. Something to think about.